let's talk about all of this and how it's affecting the market. So we'll bring in Alessio de Longis. He is Invesco Senior Portfolio Manager, joining us from New York City. Alessio, it's good to see you. So we see these jobless claims numbers diminishing in severity, and it seems like that's true for many of the economic numbers we've been getting. You guys remain pretty defensive when it comes to market positioning. So how are you thinking about what we're seeing on the economy and how the markets are going to respond?
We remain defensive with respect to the stance on equities, and we think that there is creative ways from an asset allocation standpoint to actually begin to harvest some of the attractive risk premia, increase risk in certain parts of the portfolio. So before we get to that, what is happening is the market has obviously recovered much of the losses, if not most of the losses from the peak. And that's a result of seeing economies gradually reopening, discounting the fact that somehow this will be a temporary event. And the summer brings in some bright spots. The risks remain, in our opinion, that in the fall or in the winter, we may have a return of the virus or a combination of disappointing news. So when you look at that scenario, you want to take into account the impressive, unprecedented monetary and fiscal stimulus, as you alluded to, that has already taken place and may continue to take place. In that scenario, we think credit markets will offer should be offering the best risk return profile to navigate through these false starts in markets, right? We expect equity markets to be somewhat trendless with a lot of volatility, with good quarters and bad quarters, but credit markets tend to outperform equities at the very beginning of a recovery or in a recessionary environment like we are today.
Okay, so Alessio, if we're moving between this back and forth of recovery and then perhaps, second wave of pandemic slowdown economically, what should an investor look for in equities to signal potentially it's time to go from credit markets to perhaps equities?
Yeah, that's a very good question. In equities, you want to begin to see, as a leading indicator of the broader market, you want to begin to see cyclical sectors or value and smaller caps companies begin to outperform. When you think about value and small caps, these tend to be the most cyclical, the sectors of the equity market with most operating leverage, and they are more sensitive to the global backdrop. So look for value to begin to outperform growth, look for small caps to outperform large caps. And we have frankly seen some of that this month, in some cases also by large amounts. So a continuation of that is certainly a good sign.
Alessio, this is Dan. I kind of want to ask about, the risk in the way we're seeing these jobless claims. Initially, they were a lot of workers who were impacted, maybe delivery folks because restaurants are closed, or workers in kitchens, hotels, resorts, things along those lines. And as we still see, as each week goes by, several million more jobless claims coming through, is that maybe an indication that longer term jobs or jobs that aren't necessarily in the service industry are now being hit? And does that speak to a greater issue for the economy as a whole? And then perhaps that hopefulness that we'll see a rebound quickly ahead of anything coming in the fall, that may not be there.
You're highlighting a key point here, and that is the key indicator for us to distinguish between the short-term impact and the longer-term impact. In the short term, we have had really a rising unemployment, mostly because of a supply disruption, like the shutdowns. Over the long term, the key driver of that will actually be global demand, right? Whether it's in the country where the unemployment is rising, or demand missing from the rest of the world. So I think the primary concern that I have, the primary consideration that is important to keep in mind is this picture, it really signals lack of inflation for a long period of time. Rising unemployment will maintain an environment where capacity is ample, demand is weak, and is unlikely to come back as strong as before. It will be a slow process. I think the primary implication of that will be probably improving productivity, but loss of inflationary pressures in the economy, which were already nowhere to be found before.
Alessio, I also want to bring China into the conversation because we once again have the president sort of ratcheting up the rhetoric against China. China separately talking about potentially imposing more curbs on Hong Kong. It's imposing new national security laws there. So how does that affect as we sort of move through this pandemic? How does that affect the economic path to recovery?
Well, political and trade, especially trade-related tensions that we've learned throughout the last 2 years certainly don't help. And at this time where sentiment in the economy is particularly weak, that's something not welcome. So from my perspective, look, I think there is that risk. It's difficult to imagine, especially that either country will really have an incentive to push this tensions to the extreme, given that it will hurt both economies. For China, it's important to maintain having economic growth to maintain social stability. For the U.S., it will be important as they go into the election. The administration will not have an incentive to push this rhetoric too far. Now, with that being said, this is for the short term. In the long term, I think we really have to watch and hope that this pandemic will not lead to rising tensions on a global basis in the long term in terms of deglobalization and a desire to bring the supply chains closer to home, or at least diversifying them away from one economic source, which was the model that we basically lived through for the last 20 years. And that may come with tension.
Yeah, Alessio, just thinking about your base case scenario here, in my mind, it's still a bearish outlook, right? We already know all of the tailwinds that will be following us over the next few years. Are there any sorts of headwinds that we're not actually taking into account right now? Because over the last few weeks, it looks like investors are still feeling pretty optimistic that, once the vaccine is in order, we'll be okay, or the investing environment will be palatable.
Yeah. So I would say yes. Our base case scenario is still somewhat defensive and bearish, for lack of a better word, because especially with respect to a stance of having a bit of a below average risk posture and less equities than otherwise you would have had to begin with. But headwinds to consider. I think the primary headwinds pertain maybe for long-term prospects for equity earnings. And the ability for the economy. So markets have clearly priced in a V-shaped recovery, and that's primarily because of the stimulus behind it. The next stop will be really to see the earnings and the cash flows, so the fundamentals validate the price action. And that's the subtle point of why we think at this stage, as a global investor, you're maybe better off considering overweighting meaningfully credit markets, because credit markets offer at this stage equity-like returns, but we think with somewhat less risk, because credit markets are more sensitive to monetary stimulus and the easing in financial conditions, and they're senior in claim to equities in terms of having a claim to those cash flows.
Alessio, thank you so much for your perspective. It's great to see you. Stay well. Alessio de Longis is an Invesco Senior Portfolio Manager. Appreciate it.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.